Nick, if you want, man, I'll just kind of click through as you keep going.
Excellent. Yeah, so today we're talking about cost segregation. It sounds like most of y'all have a pretty good understanding, or at least have heard presentation from me or some of my colleagues in Madison nationwide. So we're going to go through it, and if there's any questions, feel free to stop me along the way, and we can kind of get in the nitty gritty. And if there's anything I don't know specifically, I can always get you an answer, and then have an answer for you tomorrow or next week. So let's get into it. So we're going to discuss what is depreciation, how cost segregation works, what is bonus depreciation, and when's the best time to do this. And then also what's really important, and this week I've had a lot of people asking me about this, is what makes an active real estate professional. And we'll look at a case study too. We can go to the next slide. So depreciation you have to take on your property. So a lot of people were talking about single family homes. Whether you're doing anything or not, you have to take depreciation on that. So that's just called straight line depreciation, simple depreciation. It's the cost of the property minus the cost of land, and it's dripped out over 27.5 years. If it's an office building or retail, that's going to be 39 years. So the 27.5 years is for residential properties. And as we should know, apartments, even though we consider them commercial real estate, they are still residential property. So they're going to depreciate over 27.5 years. So there is a tax planning technique that can go in there and separate all the items inside the building that depreciate faster than that original 27.5 year schedule. And so that tool is called cost segregation. So the tool is cost segregation, and the benefit it provides is accelerated depreciation. And we like to say accelerated depreciation because we're not giving you more depreciation, we're just accelerating it to the front of the depreciation schedule. So there are several different types of assets on a property. There's 5, 7, and 15 year, as well as the standard 27.5. And so if you don't accelerate the depreciation, you're taking an asset that would depreciate over 5 years, and you're depreciating it over 27.5 years. So you're not getting the full benefit of depreciation.
Hey,
so
Nick, could you clarify something for me on the depreciation side? While you're accelerating depreciation in the initial term, do you the depreciation over, if you were to stretch it out for the 27.5 year life, it's the same amount of depreciation. You're just pulling it forward.
Exact same amount.
Yep.
And so here we have an example of what straight line depreciation looks like. So you purchase a property for $1 million. Let's estimate 15% of that is the land. So we subtract that, and what you're left with is your depreciable basis. So in this case, $850,000. So in straight line, we'll see over, if it's a commercial property, like a strip center, that's going to get you $21,000 more or less each year in depreciation. If we're an apartment complex, we can see right here with a shorter depreciation schedule, 27.5 years, you're going to be receiving more depreciation annually. And why does depreciation matter? Depreciation is considered a loss in taxes. So you can use those losses to offset any gains you have. So if you're making $30,000 from your apartment complex annually, net, then we can offset all of that with this depreciation. So depreciation knocks out taxes. So with the cost segregation study, what you do is you're hiring an engineer to physically inspect a property. So with this this office building on the side here, we would send an engineer there, and they would see everything that you could see in this picture: the asphalt, the sidewalk, all the landscaping. If you look up at the top, there's a little security camera. All of those assets, they're identifying all of that, and then everything on the interior, and they're compiling those in a report. And so why are they doing that? All of these specific assets have a different depreciation schedule, a different depreciation life. And those lives are going to be much shorter than the actual structure itself. So in this case, this structure depreciates over 39 years. All of these exterior assets are depreciating over 15 years. So you need to identify, capture, and accelerate all of these assets, which gives you significant non-cash deductions. So that's how we do it, is with an engineer who's actually visiting the property. And so I've talked about the different asset classes a couple of times. With multifamily, you're going to be dealing with a lot of 5 and 15-year property. So the 5-year property, we like to say, is everything on the interior of the building. So that's your carpet, your flooring, your millwork, any furniture, mailboxes, sometimes even specialty wiring, specialty HVACs. So all of these assets on the inside, they depreciate over 5 years. Then on the exterior of the building, this is going to be where all of your amenities are, especially if you're adding amenities. So these are patios, grills, any exterior lighting, any pools, fences, all of that stuff depreciates over 15 years. And the good thing about the 15-year property is it's huge stuff. It's really large things. So things like sidewalks and parking lots, and take up a lot of space. So that's a lot of value that we can accelerate. Sometimes when people invest in triple net retail leases, they're basically buying a shell building, and there's not much inside of it because their tenant owns everything on the inside. So they think there's no value to me because there's no 5-year property on this asset. But just on the exterior alone, there's a lot that can be accelerated with the parking lot, signage, especially if we're talking about big signs. I mean, that could be $20,000 to $50,000 signs that can be accelerated. And what's not on this page here is 7-year property, which is much less common. But 7-year property is going to be owner-operated assets. So those are things like, let's say you owned an old folks home or a medical building. Like if you're a dentist and you own everything on the inside, all of those assets, they depreciate over 7 years. So for example, we had a client who had purchased an old Burger King, and it came with everything on the inside, all the grills and all the fryers. And with all that 7-year property, they were able to accelerate, I think, maybe 60% of the property. So that means if they bought it for $1 million, $600,000 of it can be used as bonus depreciation or accelerated through cost segregation. So cost segregation, the benefits of it, we estimate on average for every $1 million of reclassified assets, you're going to get $200,000 in after-tax cash savings. So like I said before, that's going to reduce your tax liability. When you've reduced your tax liability, you're increasing your cash flow. So you've got more cash that you can pay off your investors with, or you can do other repairs with, like fix your roof. So basically, just freeing up cash flow. And what's really important about cost segregation, like we said, we're accelerating the depreciation. So your biggest benefit here is the time value of money. So a lot of y'all, I'm imagining your hold time, it could be much longer, but if we're working with a 5 to 7 year hold time, there's a lot of assets like the 15-year property. They're not going to be fully depreciated during the time that you're holding that property. So this 15-year asset, you're depreciating it over 29 years, you're dripping it out, and you're selling it before you're getting the full benefit of depreciating that asset. So that's why we like to accelerate the depreciation so you really get all that benefit as soon as possible, especially with bonus depreciation, which on the next slide, we'll go a little bit more in depth in bonus. So bonus depreciation has existed since the 80s, late 80s, in some form or another, whether it was 40%, 50%, or up to 80%. So in 2017, with the Tax Cuts and Jobs Act, we now have 100% bonus depreciation. So I'm talking about all these asset classes, 5-year, 7-year, 15-year. When we reclassify them, they're still depreciating over 5 or 7 or 15 years. So you're getting more benefit out of it, but you're not getting this huge chunk all at once. With bonus depreciation now at 100%, you can use all that all at once. It's not for everyone because, like I said, we're using depreciation to offset income. So if you don't have $600,000 worth of income to offset, bonus depreciation might not be for you. But especially with active real estate professionals, it can be a huge benefit. We'll go to the next slide, please. So it's for all assets that are under 20 years. So the structure, the roof, the windows, that cannot be used as bonus depreciation. But like I said, all these 5, 7, 15 years, and the 3-year can be utilized in 100% bonus depreciation. You cannot do it on a property that you've bought and you're going to sell in the same year. So it has to be at least 1 month over that 12-month period. And so, yeah, it allows significant non-cash deductions in one big lump sum in year 1. And on the next slide, we'll see that it actually is diminishing every year, starting in 2022. So let's say you bought a property in 2016, you were not eligible for 100% bonus depreciation. But after September 28th, 2017, you were eligible for 100% bonus depreciation until 2022, the end of 2022. So every year after that, it's going to drop down 20%. So we came from less than 100%, looks like we're going back to it. And then by 2027, in theory, bonus depreciation will be totally gone. That would be possible, maybe. I think with someone like, I think Elizabeth Warren had discussed that in her platform. It doesn't look likely. I can't imagine any candidate in the future completely erasing bonus depreciation. Maybe we'll go down to 50% or 80%. And so maybe in 2025, we'll kick it back up again. But,
what was the reason for that?
Why would they remove bonus depreciation?
Yeah, why would they be kind of against? Is it this impacts certainly more than just real estate, right?
Yeah, absolutely. So whenever we hear in the news that someone like Boeing, Amazon, or Donald Trump hasn't paid income taxes or corporate taxes, it's because of bonus depreciation or even just regular cost segregation. So a company like Amazon, they've got how many warehouses globally? Every single one of those $100 million, or let's say $5 million warehouses, they can do bonus depreciation on every single one of them. So even if they're making, I don't know, $100 million, whatever they're making an income, they're able to offset that with all of the real estate and physical assets they own. So with Boeing, all of their planes, they can use bonus depreciation to offset all of their income. So the reason why we do this, why the government allows depreciation to offset income, is to encourage investors to purchase and to improve their properties. Because assets really do depreciate. It's not just a paper, paper benefit. In reality, when you install a roof or when you install flooring, it's going to depreciate. And with flooring, let's estimate 5 years. So maybe in theory that this floor is going to outlive the 5-year depreciable life, but it eventually needs to be replaced, or else we're going to have slumlords across the country. So they want to encourage people to improve and renovate their properties and stimulate the economy. But it's a loophole. I mean, whether it's a positive loophole or not, it's a tax loophole. So people on the far left, they do want to close off that loophole because it's just another way to bring more funds into the federal government.
Thanks for that. I mean, sounds like there's enough lobbying pressure from large enough corporations to continue to potentially.
Yeah, what my colleague likes to say is that most members of Congress own real estate, so laws are written to benefit. Who should do a cost segregation study? Not just senators. Everyone who owns an income-producing property should at least consider doing a cost segregation study. So whether that's individuals, TICs, syndications, estates and trusts, corporations, partnerships, LLCs, everyone that's got to pay income taxes. So if you're a nonprofit or you're a church and you recently bought a new building, yes, there are depreciable assets on there that could benefit, but you're not paying taxes, so it's not worth it. There's nothing there for you. In addition to that, we like to say at $750,000 and above is when you should consider it. A lot of people say $1 million is where you really start to see a benefit. It's worth considering at $750,000. It depends what the property type is. Certain assets like warehouses, they're essentially shells. It's the roof and walls. So there's not so much that can be depreciated. We can maybe get 15 to 20% on it, but with multifamily, because there are so many other assets, you're looking at maybe 35%, sometimes up to 40. So income producing, $750,000 and up, and if you've owned it for 7 years or less. Why 7 years? If you've owned it for 7 years, you've been depreciating it every year for 7 years. You haven't been depreciating it as much as you could have, but you're still getting some benefits. So by 7 years, there's probably not much value left for you. It's not worth your time or the money of the study. Active real estate professionals. What does it mean and why does it matter? So you qualify as a real estate professional for the year if you or your spouse meet the two following requirements. So I'm going to read them in full because this is a really, it's not that complicated, but it's sticky and it's really important for a lot of people. So more than half of the personal services you performed in all trades or businesses during the tax year were performed in real estate property trades or businesses in which you materially participated. So what are those trades? Development or redevelopment, construction, acquiring, converting, renting, leasing, operating, managing, or brokering. So those are the trades. Materially participating, what does that mean? So if I am hiring a guy in Oklahoma City to purchase single family rentals, manage it, and just send me a check every month, I'm not materially participating. You have to actually be involved. And it doesn't necessarily mean that you have to be physically painting the house, but it means you got to be involved somehow and you have to be able to prove it. And then the second thing is performing at least 750 hours of service during the tax year in real estate. Sounds like a lot. I think it's around, what, 14 hours a week, maybe less. But what you're doing right now is an hour of service in real estate. So every meetup you go to, every class you take, every site tour, every time you drive around, log those hours. Now, when you file your taxes, most of you have probably seen this already, it's just a simple box, active real estate professional or not. So it's going to be between you and your CPA to decide whether that matters. And like for brokers too, I believe if you're just if you're a broker and that's where your income comes from, that's fine. If you're taking a paycheck from a brokerage, so maybe you're working in the office for a brokerage and you're just taking a paycheck, you need to have 5% ownership of the company to work. So it's kind of complicated, but these two main things, if you've got these two, more than half your services in real estate, and you've got the 750 hours, it shouldn't be that hard to make it work and make it plausible. But don't fake it.
Can I ask a question?
Please.
If this is my wife, Nimisha. If our plan is to have her qualify for a real estate professional status because she's part-time employed and I'm full-time, if I do some of the work involved, can that apply towards her hours?
That's a really good question. I don't have an answer, but I'm inclined to say no. But I'll have to double check on that.
Yeah, so I would consult your CPA, specifically one that can deals with real estate. But the folks that I've been involved with, the real estate CPAs, you can actually look their podcast up. I think it's called the Real Estate CPAs. They basically said no, you have to have a very thorough log of your hours, and effectively they said if you have a full-time job, you cannot qualify for this. I mean, there's precedence for that.
Right.
And I don't believe you can transfer hours between spouses. So it's got to be wholly all one.
How would they know? If we were audited, how would they know who actually did the work?
That's between you and your CPA. But they absolutely do recommend having a log because they
plan on that.
The precedence has definitely been serious about keeping a log and proving it, because when people get audited, they can rip our real estate professional status up really quick in some of the past lawsuits and audits that have come down.
Thank you.
And one of the reasons, we didn't talk about this yet, but why is it so important? Most of you probably already know, but once you're an active real estate professional, all of your real estate losses become active losses and they can offset any of your income. So if you've sold some stocks, maybe you've got a side job and you've sold some real estate and you have a garage sale, so all this income can be offset by the depreciation from your commercial real estate property. So it's basically, this is when bonus depreciation starts to become magic, because you can take those losses from one property, gigantic losses, and then spread it over several different properties.
And I'd just like to make one quick adder on this. This does not exist anywhere else in the world. This real estate professional status to draw down income against your, any other income it doesn't exist anywhere else in the world. United States.
So if you're passive real estate, you can use the passive losses against other passive income. So one property to another. But yeah, if you do not qualify as a real estate professional, you're allowed up to $25,000 in passive losses. If your modified adjusted gross income is 100K or less, and then that phases out the more you make. So when is the best time to do a cost segregation study? We suggest as soon as you acquire the property to do a study. Why is that? So if your business plan is to purchase, renovate, and then hold for a period, there are several assets inside the building. So like, let's take this apartment building, this luxury apartment building on the far left. There are assets in there that you're going to junk. So there's old carpeting, there's old flooring, there's old appliances and fixtures that are just going to the garbage almost after day one. You can capture those assets in a cost segregation study, and you get the depreciation benefit on everything that's in there from day one. And so if you wait till 6 months after you've already done your renovations, you're only depreciating the new renovations that have gone in. So what we suggest people to do is as soon as they've got their PSA signed, as soon as you're under contract to purchase a property, reach out to a cost segregation provider, get a quote, see what you're expected to save. And then as soon as you close, get that engineer on site and let's do that study so you can start doing your renovations. After that, we suggest people do a study after you've done your renovations. If you do, basically you can buy 2 studies at once. Sometimes we'll do a discount, but if you've done a renovation on an existing property, you're gonna wanna do a study to capture all of the new assets and clearly identify what they are and take that depreciation. And then newly constructed property, as soon as it's placed in service, so your grand opening, whenever you start leasing, it depends on you. We can help you decide when the best place in service date is, but as soon as the property is functional, essentially, you could do a study. Why? A lot of people say, why do I want to do a study on a newly constructed property? A lot of times they just have a construction budget, and so there are estimates. We know that we spent this much to put this in, but we don't know necessarily what it looks like completely at the end. So how many square feet of asphalt, of sidewalks, of awnings, of what's on the inside, how many square feet of carpeting. It's really good to have an engineer physically walk the property and identify everything. And we do look at your construction budget and try to reconcile everything. And then this last one is really nice too. This is the look back study. So let's say you're on this call, you do have like an office building. I heard someone say, you haven't done a cost segregation study yet. And you've had it for 3 years. It's not too late. You could do a look back study. And so let's say, for example, you purchased it 3 years ago. You've been taking less depreciation than you basically deserve. So you do the study, and you're going to get all the depreciation that you missed from years 1, 2, and 3 in year 4 in a big lump. And so it's going to look like bonus depreciation without even doing bonus depreciation. So it's still good to do it even if you've owned it for several years. And it's also really beneficial for you because you've been putting off that depreciation. And like I said before, though, after 7 years, a look back study is not as valuable for the client.
Nick, is that something that is as a result of the CARES Act that they recently released? Is that something new, or has that been around?
It's actually unrelated. And so there are 2 things in the CARES Act. So I'm assuming you're talking about the 5-year.
Yeah. Yeah.
That's another benefit that makes this really huge is that if you do a study today, you can basically apply the losses retroactively. So if you've been overpaying on your income tax, my understanding is that you can take this depreciation from a study today to go back and basically get a refund. But this is separate from that. So you've got these 2 new, you've got a new benefit and you've got this old benefit. So doing a look back study, basically it starts with the first one. Do it as soon as you acquire a property. And if you haven't done that, it's not too late. Unless it's 7 years, then it is too late.
Awesome.
So here is a case study from someone in North Texas. It's a client of ours. So this is his 4th property. This is a multifamily purchase. It's 221 units, garden style apartment building. It was worth $13 million. So without cost segregation, straight line depreciation, they're going to get $400,000 more or less annually in depreciation, which is nice. It's good for what this property might be making. But if we go to the next slide, so we'll do the breakdown like this. We start with the purchase price of $13 million, and we have to identify how much is going to go towards land. Whenever we do a study, we always defer to the property owner because we want to know, what do you think is really accurate? 15% is our default for saying how much of the building is land. But if you live in California or New York, that's going to go up to 30% or more sometimes. If you're in Temple, Texas, that maybe goes down to 5%. So we start with 15%, we'll work with you. But so $2 million of this property is land, cannot be depreciated. So of the remaining, we're back to 100% here, 71% of it is 27.5-year property. So that's your roof, your foundation, your walls, your windows, cannot be accelerated. It's going to be 27 years no matter what. On this particular property, we found that 9% of it was 15-year property, so $1 million, and then 20% of it was 5-year property, so over $2 million. So if this owner was going to do bonus depreciation, they would get $3 million in year one of depreciation versus the $400,000 they would have gotten straight line.
Nick, you have a loss after all the depreciation. What happens to that loss? Does it roll over to the next year? And
It does roll over.
after it rolls over and you sell the property, does it like continue to roll over? Like when does it stop? I know, or is it consumed like once the property sells?
My understanding was that when the property is sold, you'd have your reconfiguring there because you have the lowering of the basis with the depreciation. So, well, actually, I guess it would still continue to roll over. If you haven't taken it all, it would just continue. Your losses,
Okay.
yeah, because your losses stay with you. Yeah. So here are some myths we want to put to rest. A lot of people ask, is my building too old? And we say whether it was built in 2020 or 1920, doesn't matter. It starts with the purchase of the property. So when you bought it, that's when this starts over. And no, you can't drop it into a trust and roll it over and try to do a cost segregation every year with the same property. If the new company is managed by the same people, you can't keep redoing it. So it doesn't matter how old the property is. A lot of people say my CPA does all the depreciation for me. It's true and false. So we work with the CPA. We're not a CPA firm, so we do a study, we pass it over to your CPA, they file it. If a CPA is doing cost segregation without hiring an engineer, they're essentially doing guesswork. So they're assuming what they think to be 5 or 15-year property. Sometimes they can maybe have a more educated estimate. So like if you did a new construction, maybe they're working from the construction budget. But essentially, they're guessing, and in the case that the IRS looks into the study, which has happened, the owner is going to be liable for that. And so it's an audit risk to not have an outside an outside company do the study for you. And then, speaking of auditing, does cost segregation red flag me for an IRS audit? No, it does not. Statistically, it is not an IRS audit risk. And in fact, the IRS likes to see cost segregation studies done because they like to know what's in your, they want to know exactly what you own. And so they want to make sure that you're paying taxes properly. So they like to see people do cost segregation studies and identify everything and depreciate it properly because the system exists for a reason. It's not an accident that we do these studies. Recapture makes cost segregation not worth the money. And so we'll go into some more, we'll go into some depth on recapture. But really the only ways to avoid it is to sell your property for less than you bought it for or to die. So for the things you can work with, you know, if you've got a plan, a strategy for your will and everything. But let's take a look at how recapture works. So here's two options. Let's say you're doing streamlined appreciation. You get $100,000 in depreciation benefit. Regardless of if you've done a cost segregation study or not, you have to pay back recapture tax. So that's at a maximum, it's 25%. So that's all the depreciation you've taken. You can pay back 25% of that. So if you've got $100,000 in straight line depreciation, you will owe back $25,000. But you did get the benefit of $75,000 worth of depreciation that stays with you. And if you did cost segregation, you might be getting $300,000 worth of depreciation. So we're tripling the depreciation you get. You have to pay back 25% of that. That's $75,000. So $75,000 is, yes, it's indeed more than $25,000, but you get to maintain the benefit of $225,000 of ownership. So there's recapture. There's also the lowering of the basis. So you're going to be paying more in capital gains tax if you are doing cost segregation. But with both of these combined, the benefits you're getting from cost segregation is still going to be larger than the taxes you're going to be paying back. And on top of that, you're getting the time value of money. So you're getting to utilize that money now to invest in another property so that if you have to pay it back later. Also, 1031s are another way to keep kicking that can down the road. That's not completely erasing it. We have to remember, we're never erasing this tax liability without dying or selling for less. But you can kick it down the road with a 1031 exchange.
And the benefit with that, you know, if you do die or whenever you die, if you leave the property to your kids, to my knowledge, they wouldn't have to pay the recapture tax, right?
100%.
Yeah, the basis is stepped up.
Capital gains and for recapture tax. So something to consider maybe for that last big property. So this is something we came up with. It's the individual depreciation benefit. So if you've got a deal and maybe you've got it under contract, we get you a quote for what you would get in depreciation from cost segregation. We can then go a step further and break it down for you what each GP and which each LP would get in depreciation benefit. So this has been helpful for some people because certain investors, yes, they want to see what return they're going to get, but they also want to see the depreciation and the tax benefit they're going to be getting, because otherwise they can be investing in stocks or Bitcoin or something like that. So what we'll do for you is if you want to see what this looks like, we can easily just break it down for you and show what each individual investor would get in depreciation. And we've seen that several GPs, sponsors have raised significant equity just by using the cost segregation benefit. Some people who they really need that tax benefit. So reach out to us. We're happy to break that down for you. Which I look for in a cost segregation study. Here are the IRS's guidelines. They break down everything they want to see. So we just follow that to a T. So you want to have an engineering-based study that's done by an outside party, and you don't want to see contingency fees basically based on what they're going to save you. Like when you do your property tax protest, they're going to get 30 to 50% of the savings they get you. With the cost segregation study, you really want to see a flat one-time fee to basically show that, look, we don't have any financial gain. We're going to do the study for you. We're going to get you a lot of savings, but we're not going to fudge the numbers because it doesn't benefit us to fudge the numbers. The benefit is getting you these tax savings and making the IRS happy and make them leave you alone. With Madison Commercial, Madison Specs, we offer 100% audit protection, and that's because we follow the IRS's guidelines. Whenever they reach out to, if there ever is a question on a study, for no extra charge, we back the study 100%. And any additional fees that may come for backing it and explaining with the IRS, we take care of that. And then we've never had any problems because we're following what the IRS wants. So as long as you follow the guidelines, there's no problems. So a little bit about Madison Specs. Go to the next one.
Yeah, sorry, Nick. I clicked a little too fast there.
No worries. So Madison Specs, it stands for Specialized Property Engineering and Cost Segregation. So we offer an engineering-based study with in-house accountants and tax experts. So our leadership comes from Big Four accounting firms. So like I said, we're not a CPA firm, but we've got CPAs who are in the back end checking each study and giving the check off on each one. So far, we've done 14,000 studies in the last 13 years, and we've gotten $4 billion in tax savings for our clients. Like I said, 100% audit protection. So I think we've only had 13 of our studies called in question, and we've won every time. So.
And Nick, this is Ron. I see you say 14,000 studies nationwide, so I'm assuming that you guys perform cost segregation outside the state of Texas too, huh?
Absolutely. Yeah, so we've done all 50 states. We can also do studies in other countries. So if you have an owned property in foreign countries, in fact, one of our head engineers is he's born in Italy, moved here, but he actually got to go to Italy to do a study for an owner who had a warehouse or a factory out there. So yes, we've done all 50 states. It doesn't matter where it is. We'll get it done. And right now, most of our engineers are coming back online. Our Texas engineers never stopped. But some of our engineers, like in New Jersey and in Georgia, they had to slow down for a little bit. But most of those guys are back online. If a client has a property that they're worried about having an outsider walk the property, even though a lot of places are opening up, we're still doing digital virtual tours. So a client can go through with their cell phone and basically do a Zoom call and just walk the property, and our engineer will guide you to say, walk here, walk here. It goes very quickly, and basically it records everything. So our engineer has a lot more information, and then they can do the study virtually. And then we'll go back later and double check everything to make sure we didn't miss anything physically once things get back to normal. And then next slide. So Madison Specs is a part of Madison Commercial. So it's this full suite of commercial real estate services. So the company is headquartered in Lakewood, New Jersey, and we've got offices in Dallas, Houston, Cleveland, and we've got some guys in Israel as well. And so we do title. Title is really the bread and butter of the corporate guys. And then we also do lease probe, real diligence. So those guys do CAM auditing, lease abstracting, and physical and financial due diligence. That's a little bit more for retail and office space, but we have had some local clients who've used that for multifamily purchases. And then we also do 1031 exchanges. We're a licensed intermediary. And then doc probe is for trailing documents, but that's for residential title. So we do basically the full suite, everything but brokerage and management, I would like to say. Yeah, I'm just in the cost segregation department here in Houston. And the last thing here, if you'd like to see a free feasibility study, like I said, we like to do it once you've got a contract. But if you're interested in seeing just, hey, I'm looking at properties, saw this on CoStar or whatever, we can do, I can run like a quick and dirty cost seg estimate to kind of see what you might get in savings. But to do a feasibility study, we just need three things. It's the address, the closing date, and the purchase price. And then there's a few more things, like if it's a look back study, we need to see your past depreciation schedule. But with those three pieces of information, we can get you a pretty accurate cost segregation estimate of what your savings are going to be and an exact cost for what the study will be. And here's my number. You can take this down as my cell phone, and then I've got my email address here for any questions or any, if you want to see a feasibility analysis, I'm always available by phone or by email. And hopefully in person, maybe in a couple of weeks, not yet.
Hey Nick, we saw your buddy Josh not too long ago. Cody and I braved out and went to eat falafels with Josh. So.
Oh really?
Yeah. Madison Title.
Yeah. Well, did y'all go to Dino's?
Yeah.
Dino's, yeah.
It was awesome.
Dino's.
Best falafel I've ever had.
The place is fantastic. Yeah, Josh is braver than everyone. I feel like it's. Go ahead.
I was just going to say to everybody, like Nick said, Madison's full service. So we met with the title department. Nick's on here tonight with Cost Seg. So man, they run the full gamut, and they're pros for sure.
Yes.
Hey, this is Aisha with Heritage Texas Properties. Quick question on Nick. What exactly, or what's the details of your feasibility study? Could you briefly walk me through some of the chapters of what's included in that feasibility, if you don't mind?
Yeah, absolutely. So yeah, feasibility is a little bit shorter. I think, like I said, the actual cost segregation study is like a 90-page document that itemizes every single asset on the building, right? So literally everything they found, they took a picture of, that's in the actual study, and that's what goes to a CPA. Feasibility study is basically, it's an estimate of what we can find on the property. So we're working with whatever you can provide us. So if you have anything like an offering memorandum, if you have a survey, any kind of documents, blueprints, that stuff would make it really accurate. But we're working with Google Images, Google Maps, and CoStar and things like that to basically find how much can we expect to get in a 15-year property and how much can we expect to get in 5-year property. And so basically telling you that, look, you're going to get, $300,000 in depreciation that you can utilize. And that's going to be over, this is what it'll look like in bonus depreciation. And this is what it's going to look like doing just regular cost segregation, which would be dripped out over 5 to 15 years. So you'll get to see graph charts describing the savings, the timelines, and then the cost of the study, like I said. And then there'll also be, part of it is like the engagement letter. So essentially, like if you were to get one from us, it would say what the relationship would be like if you were to hire us, how the payments would work, things like that.
Perfect. Thanks for the clarification.
Yeah, and I might be able to send, I'll see if there's one that maybe if we don't have the name on it, we can maybe send to you to look at if you're interested.
Absolutely. Absolutely.
Hey, Nick, I want to go back. There's one aspect to the recapture tax that I kind of I was hoping you could talk about. And Yona and I had this conversation as well. And this was the first time I'd ever heard about this. But there's a way to even further reduce your tax recapture tax on that. Can you speak to that?
Absolutely. So when we say that recapture tax is 25%, that's the maximum. So all this is about depreciation, right? These are depreciating assets. So we're identifying them at year one, that you have this 5-year asset, a piece of carpet, let's say, for example. 5 years later, you sell the property. Well, why would that asset that depreciates over 5 years still retain its entire value at year 5? So your CPA is going to look at and see these asset classes and be able to decide basically how much value is left in each of these. We can't say, because there's always scrap value for most things. So our head CPAs like to throw the IRS a bone. So there's something is going to be left of every asset. So let's say your 5-year asset classes was $100,000. Maybe there's only $20,000 of value left at the end of it. So there's a way that we can work with your CPA to basically make sure that you're paying less than 25% of recapture.
Yeah, that's great. I think a lot of people probably had not heard of that aspect of the recapture tax component. And I mean, the more that we can continue to save, even when we sell, the better, right?
Yeah, because recapture is scary. I mean, people are thinking that I'm getting this saving now, but I'm going to get messed over when I sell the property. But there are ways to mitigate that. And there's a reason why people are doing it and paying money to have these studies done. It's because the benefit outweighs the taxes. And that's the same thing with real estate too. If we didn't want to pay the taxes at the end, we wouldn't buy the property in the first place, because taxes, a little bit of taxes, right? We don't want to pay a lot. We're using the depreciation to offset that.
Bare
A
minimum.
little bit of taxes means very little. Maybe none, if you can get away with it. But paying some taxes means you made some money.
Yeah, Claudia, tell us how much your year one depreciation was on the cost basis.
I was talking to Martin actually a minute ago, and it was about 85%.
Yeah, that's what I remember. Yeah.
Wow. Yeah. And actually, I was going to ask a question to Nick on the costs, just for everybody to.
Oh, how much does it cost?
Yeah, how much does it cost? Is it
Good
related
question.
to the cost of the property? Like we paid, Fairfield Co., we bought it for $10.5 million, and we paid around $3,000. So is it related to the cost of the price of the property, or what?
The cost reflects the size mostly. So it's typically the size of the property and the complexity of the property, and then also the location of the property. So there are travel fees associated. So if it's out, if they're gonna have to go to Alaska, it's gonna be a little bit more expensive. If it's gonna be in Houston or Dallas or Atlanta, places where we have engineers on site, it'll be a little bit cheaper. But yeah, we see between $3,000 and $7,000 is kind of your range. And you can assume it's going to be correlated to the price of the property, which correlates to the size of the property. There's just more assets to capture, and there's more rooms, and there's more room types, because we have to, if there's a 1-bedroom, 2-bedroom, and 3-bedroom, when we have to know exactly what's in each one of those.
Okay, thank you.
David, I know you just closed on a property in December. Did you guys ever do your cost seg study?
Yeah, it was a little over $1 million on 3.1 million.
Awesome, man.
Yeah,
Awesome.
was silly crazy.
You do bonus?
It's pretty awesome. Yeah, it's pretty awesome.
It's good,
So,
crazy.
It was expensive though. Ours ran us $7,500. So yeah, I believe they came from Utah. That's where 3 of our partners are, which is fine. So there was costs involved in that. Building was built 1967, I believe. So yeah, it was a learning experience. It definitely blew my mind. So.
Yeah, I like this quote by Garrett Sutton. He said, "Our financial and tax and legal systems are set up to reward property owners." And so we see all these structures, especially with bonus depreciation, cost seg. This is brings that quote alive.
Yeah,
Huge. It's huge.
And Nick, that's what's so powerful about what you guys are doing at Madison. I don't know if other companies are doing this or not, but the way that you break it down to see just how each individual investor can benefit from the depreciation, right? We shouldn't be investing just for tax purposes only, but there's a lot of people that are looking for that tax shelter, right? They need somewhere to offset some of that high earned income. And so, I think it's just really powerful tool. And somebody else commented on this in the chat box as well about how, you can break that down and you can see these potential deals that you're looking to invest in.
Yeah, we're here to service commercial real estate investors, and it's a way to make you look like an all-star, because everyone is going to get this depreciation. If you're a multifamily investor, if you're smart about it, you're utilizing cost segregation, but maybe not every sponsor is demonstrating the benefit clearly enough to their LPs to basically attract more equity into the deal. So,
Yeah, I really like your table. That was your spreadsheet of the example. That's very powerful to communicate to people. And some people don't, I know Prasant's looking at the real estate professional status, but when you really get past that passive activity loss limit, your kind of benefits wane until you want to kick it up another notch with the REPS status, real estate professional status. So you can keep scaling this if you have the capability and time.
True. Saw David's message there. I'm going to save your email.
Yeah, I missed it when you put it up, writing it down. So just after the call, I sent my email address. Just fire it off, please. I appreciate it.
What does Sunrock always say, Claudia? If your CPA tells you don't do a cost seg study, find you a new CPA.
And hopefully you all have CPAs that you can recommend. If not, we have CPAs too that we're willing to look into that.
Did anyone else have
those are expensive too.
Yeah.
It's worth it.
Good ones.
Well,
yeah, I know. It's just shocking, the prices, but it's definitely worth it.
Did anyone else have a question for Nick or anything they're wondering?
Appreciate you. That was good.
Appreciate y'all. Thanks.
Yeah,
Is the activity picking up in your shop?
Finally, yeah. We were really, really slow. I'm assuming everyone was very, very slow. But yeah, we're picking up. Folks we're talking to, and the lenders, brokers, seems like everyone's seen a little bit of spike here at the end of May. It's been good.
Just out of curiosity, do you have more people in Houston that y'all work with, or is it in Texas, or what? Because I know y'all have multiple people throughout the country, specifically, the Houston location.
Yeah, it depends. So in Houston office is about 3 years old. Josh Ben-Perot started the Houston office. So Houston I feel like not so many people we work with just yet. I mean, it's a decent base, but it's growing. And then in Dallas, for sure, we do a lot of work. A lot with Sunrock Group. But the company's based out of Lakewood, and so we do a lot of work in New York and a lot of work with the Jewish community up there too. So it's we're growing down here. We're excited to grow down here.
Hey, Nick, I just had another question that just came to my mind, but I know you mentioned in your presentation briefly about doing a cost seg study after a renovation. So say, for example, in your case study that they did a cost seg study and then they collected the bonus depreciation year 1. And then say in year 3, they do a major renovation, say they replace the roofs. So say that happened in year 3. Are you saying that they should do another cost seg study year 3 and they're able to conduct depreciation on that as well, or?
Absolutely. And so the reason why, and also the renovation, not just year 3, I'd said year 7 is when things kind of taper off. When we're talking about renovation, anytime you do a renovation, you've put new assets onto the property. So if this is your 15th year, you know, in your first apartment complex, 15 years from now, you do a major renovation, definitely do a cost segregation study because all those assets. Another really important thing about doing a cost seg on renovations is that almost everything is going to be cosmetic. So yeah, you mentioned a roof. A roof is one of the things that's part of the structure of the building, so we cannot accelerate it. But everything else you do, like appliances and floorings and exterior improvements, putting in carports, things like that, a lot of that stuff is depreciable. So that's why renovations are usually, you put in, you know, $300,000, you might be getting $250,000 of depreciation benefit.
Hey, Nick, let's go back and talk about the 2 new things that just came out of the CARES Act that impact cost seg. So we talked about the 5-year back. Yeah, I don't know what the official term is, but you know what I'm talking about. And then also, I think there's a new definition for qualified property, right? Yeah, can you talk a little bit about that?
Yeah, so qualified property, so this is for y'all that are considering getting into retail. So there was something called a retail glitch, but essentially all these renovations that we're discussing, if you were to do that on the inside of a retail building, for whatever reason in the 2017 Tax Act, none of that stuff it was not eligible for bonus depreciation on retail buildings. So what they've done is they've fixed this glitch because it didn't make sense. Why would retail buildings, the interiors, why can't we accelerate that, but we can accelerate the inside of an apartment building? So this qualified investment property is basically anything that's improvements done on the inside of retail buildings it's now eligible for cost segregation. So this is huge for, and maybe this is something we'll all be seeing. I know before the pandemic, there was a lot of talk about cap rate compression. And so a lot of people were looking into the retail market. Now retail is extremely risky, but maybe in the next year, things pick back up and there's a lot of good retail deals. So for anyone considering that, cost segregation and bonus depreciation are just as valuable, if not more valuable, on those assets.
Awesome.
If you say you bought a property, or I bought a property like 3 years ago and decided that, this year I wanted to go in and redo the office, renovate the office or whatever, but put in new furniture and fixtures, maybe replace all the, the appliances at the property. How would that be depreciated? Would y'all start over or would it continue with just those assets? How's that?
Which year would the renovation be? So
Excuse me?
Which year was it?
Year like 3 or 4.
Yeah, it would just start over. Ideally, you'd already done a cost segregation study before, so you captured everything the first time. But yeah, it would start over with the renovation. So it would just be with the renovations itself. So let's say we'd done a cost segregation study, and we broke out the parking lot and the sidewalk and everything on the inside, but then 3 years later you do a renovation. We're not going to be redoing the parking lot. We're not going to be reclassifying. It's already done. It's already on a new schedule. You're getting the benefit, but you're just going to be getting this additional benefit for the renovations you put in.
Okay. So every time you get, a renovation or whatever, it will kind of just start over.
Absolutely. And I'd said at 7 years, if you've owned it for 7 years, it's not worth doing the look back study. Another important thing is that you need to be holding these properties for at least a year and a half, if not 2 years, to really receive the true benefit of cost segregation and bonus depreciation. Because if you're going to be selling like right away, you have to pay back some of it, like we discussed with the recapture. And so you basically spent time talking with me and paying for a study when you really only get a really short amount of time to have this benefit. So at 2 years, year and a half, 2 years, call us, or if you're going to hold it for that long, let's get that quote and see what it's going to be worth. Otherwise, it's just not worth your time. So don't be flipping properties and getting cost seg studies done on properties you're flipping after 1 year.
Anybody else got anything?
Any other questions?
Nick, man, you just blew everybody away, man.
Everyone's sleepy now.
Nice presentation.
I think
Great
you're pretty thorough.
presentation, Nick.
Yeah, man, great information, man. We really appreciate you spending some time with us and going through that. So,
Sure.
I appreciate y'all for having me.
Thank you
Yeah,
for your
cool.
time.
Just in case I didn't mention, we did our cost segregation with Madison Specs.
She
Well-
did with the great Brian Bigham.
look, I was wondering when you asked that question earlier, I was like, man, did she go with Madison? I was like,
Can
Yeah,
confirm.
I was thinking the same thing I want to ask.
I was happy with my K1.
Yeah, we have a very good relationship with Madison, like our partner in Dallas. He has 6 properties over there, and he's done all of them with Madison. So they even like I think when we started working with them, Nick was just starting to work here. So we started the relationship from Dallas, and then we transitioned here. And now that we have Nick here locally in Houston, that's even better. Yeah.
And we'll send you, if you've got a property in Dallas or if you're based in Dallas, we'll send you to Brian Bigham too. So it's, yeah, Yona, Brian Bigham, Zach Williams too, maybe some of y'all know, but we're all a big team.
Mhm.